Let me now bring on board Rashesh Shah, Chairman and Chief Executive Officer of Edelweiss Group. Rashesh, morning. Thank you for joining us. Rashesh, your current market view is that Indian markets at these levels are factoring in all the bad news, and it's time to get greedy. It's time to put money to work. So what is making you bullish?
Yeah, I think the more abused phrase is cautiously optimistic, but I think there is room for at least. You need to stop being very pessimistic on India, because I think all the worst has been expected. I've heard, people say the rupee will go to 70 and 75 and all that. So I think the worst has already been expected, priced in. There is a lot of gloom doom that happened in April and May, especially in May. And we are starting to see that India is fairly undervalued. I don't think there is any question about, undervaluation of India. Some improvement in inflation rate. I think the RBI cut in April was a good news. Another expected cut in the next few days. So some improvement is happening, and I think that improvement should at least make you cautiously optimistic, or at least stop being completely, gloom doom the way it was.
Rashesh, 4 factors that are dragging the markets down: Europe, inflation, currencies, as well as the fiscal deficit. Do you expect at least 2 of the factors to improve? That is effect and inflation, and if so, why is that?
See, I think inflation is coming under control. I think the slowdown that RBI has been able to effect is starting to show up. And if oil price remains low, which it has been, and as long as the global economy is not growing very rapidly, we think commodity prices and oil should remain soft. Given all of that, I think the rupee has been hammered a lot more. There might be a little bit of improvement on that. So given all of that, there could be some room for improvement. So I think interest rates will come down a little bit more, inflation will come down, current account gap will also be not as bad as it was in the last year, fiscal deficit may not be as bad as it was in last year. So we'll see slight improvement on the macroeconomics. So if I put this slight improvement in the macroeconomics along with the low expectations and the gloom doom environment that prevails, again, as I said, you could be cautiously optimistic about the environment now.
Rashesh, after the GDP shocker and poor IIP growth, it is obvious that growth scare is back. Do you expect Reserve Bank of India to pull a rabbit out of the hat on Monday, and instead of 25, they could do a 50?
I think it could, though I think our view is that they might do a 25 basis point along with maybe a CRR cut. I think the pressure is there, and I think RBI itself, a couple of months ago, had clearly said that the shift is now from inflation to growth issues. So clearly, I think they are in the mood to ease. What we need now is lower interest rates, but also liquidity availability. So I think a CRR cut along with an interest rate cut would be ideal from the market point of view.
Rashesh, so your view is that at these levels, markets are pricing in a disorderly exit of Greece out of the EU. But if the contagion effect spreads to Spain, will that disappoint the markets hugely?
It could be. I think anything like a Spain issues and all that. But I think what we saw recently that, Spain got the bailout and all. And I think Greece going out, most of the investors in the world have got prepared for that. And it won't be such a big shock to the system. On the positive front, I think some people in the market are now expecting LTRO or a QE3 and some liquidity conditions to ease as the global economies slow down again. And in order to revive those economies and avoid a recession, it is expected that central banks will ease off again on the liquidity side, which will be good for emerging markets and good for India. So I think overall, I think global is on balance, unless something untoward happens or like a Spain exit. I think everything else is getting priced in and investors are fairly prepared for that.
Rashesh, at Edelweiss, your house view is that play the other end of the curve, which is get out of defensives. They're expensive, overbought and are pricing in too much of a perfect scenario. But your view is that buy infra, buy banking because they are cheap and they are available at distressed levels.
I think companies which have a healthy balance sheet, have strong management, as this interest rate cycle eases off and as some investment starts happening, will be I think the biggest beneficiaries of that. Companies which have some amount of borrowing but have assets which will get liquidated, and as the interest rate ease off, but have healthy balance sheet. They are not going in for restructuring and all. All these companies will be what we call people who have, in our words, in Edelweiss we call it the sustainable balance sheet. The companies with sustainable balance sheets will do very well. Companies which have an unsustainable balance sheet will still struggle in the coming years. Even if they have assets underlying, if their balance sheet is unsustainable, they will still have a year of struggle that will be ahead of them.
Rashesh, with this kind of price action, you can spot new opportunities as well. Where is the next set of opportunities that you've identified at the current juncture?
I think increasingly, things which have been, where investors have been very bearish, is where I think investors are now seeing opportunities either from a valuation point of view or from a, technically oversold kind of environment point of view. I think obviously everybody will look at banks very carefully because the NPA cycle has been there, but the NPA fears have already been priced in. This interest rate cut and liquidity easing off will be good for banks. I think a lot of the banks still have firepower for growth. Credit growth is still not very bad. So overall, I think banks and other such interest rate sensitives will come back strongly.
Rashesh, so at current juncture, what is your tactical call and what is your structural call? And before you answer that question, Rashesh, just for the benefit of our viewers, tactical call means near-term call, structural call means long-term call.
I think currently the tactical call that investors should play should be the interest rate related. So again, the rate sensitives is a much easier one to play. On a structural one, I think over the next 5-6 months, investors should look at the macroeconomic parameters, and as they start easing off, they should start increasing their equity allocation into good solid companies with a 3-4 year view, not just a view on the interest rate cycle.
Rashesh, you like infrastructure, but infra by definition is a very large space. What is it that you like within that? Would it be builders, asset owners, or cap good stocks?
I think in infra companies which, I think especially EPC companies which are solid, which have good execution capabilities, which have good order books are one very obvious bet. The other is, I think, companies which are asset owners, the infrastructure asset owners, who have operating assets where the execution risk has gone away. They have already power plants which are operating, or other assets like roads and airports and all which are operational and already throwing out cash, are the ones which will also do well. So I think operating assets and the EPC companies are the one which will be the more obvious bets.
Rashesh, final question. A business which you represent, a business which you own, and the business which you run, the NBFC business. Is the NBFC business getting crowded, or you think FY13 for Indian NBFC industry will be a strong year?
I think NBFCs have shown very healthy credit growth in the last few years. I think again NBFCs is also a very broad sector, but on the whole I think NBFCs should do well. NBFCs should expect credit growth of about 20% plus or minus, plus the interest rate cycle and the liquidity cycle. If it eases off, it will be a good thing for NBFCs.